Okay, you had a post this weekend called "Who Owns the Stock Market," and you shared this graph with me last week, and I thought this was really interesting. So it looks at the ownership of U.S. corporate stocks since 1965, and it goes to 2019 and shows how it changes over time. Taxable accounts accounted for roughly 80% of stock holdings back in 1965. Now it's eyeballing at 25% maybe.
No wonder Warren Buffett crushed it in the 50s.
And so now it breaks it out by foreigners, which I guess is sovereign wealth funds and then rich people, but that makes up like 40% now.
It was also direct investment. So one of the examples I gave was Siemens. If they have a U.S. subsidiary, they count that all as owning. So it's not, yeah.
So where did you find this one?
I saw somebody tweet about it. I can't remember. But this was from the Brookings Institute. That's where the work was done.
And of course, now there's a big growth in, so defined contribution plans have grown a lot. Defined benefit plans have shrunk somewhat. That's just pensions. Then it shows IRAs and then nonprofits and life insurance accounts. But I guess my biggest takeaway from this is, does the fact that the changing composition of the ownership of the stock market here, like there's far more tax-deferred accounts than there ever were. It used to be way more taxable. Now it's way more tax-deferred. Does that make the stock market a little more long-term in nature?
Have you
Is that too much of a stretch?
Have you seen 2020? Aren't you the person that's saying that booms and busts are going to happen quicker? I've been listening to your podcast, and that's what you've been saying.
I don't think that really. I don't think that's two different things, though. I don't think that really negates the other.
Those are complete contradictions.
Okay, what if people are speculating their taxable accounts that make up a smaller percentage now, but they're leaving alone their defined contribution plans and IRAs and such?
Yeah, no, you're correct. Retirement accounts are becoming a bigger piece of the market, but you could also make the case that because those people are, thinking long term, they're not really turning over their portfolio, that what's moving the needle is what it's always been: HFTs and institutional money. So I think that, you're right, but I don't think that's going to necessarily change the way the market acts.
Okay, it is surprising. I mean, obviously here there's a lot of legacy stuff here, but it looks like pensions are basically the same size as 401ks, which I think would surprise some people.
I'm surprised that pensions are still that big. Actually, pensions could be bigger because this is only showing the stock market.
So there was actually a story in the Washington Post, and Edward Wolf, who's an economist at New York University, he's always got a lot of good stats about ownership of the stock market and wealth inequality. And he looked at it and found there's like 5,300 pensions sponsored by state and local governments, $2 trillion underwater as of June 30th. And that is also at a time when the fund's assets reached an all-time high of $4.7 trillion. So there's $4.7 trillion in state and local government pension plans, but they're $2 trillion underwater, even though their assets are at an all-time high. So this is almost a case of them having so much money, but it's almost like no matter what they do with their investments, they're screwed, because it's almost like no matter what you do, if you don't save enough, you're out of luck. So this is almost like a personal finance issue for them. They didn't set aside enough money at the start, and now even though they have more money than they ever had, they're still screwed.
I think that's always the issue, is that you should never count on your investments to bail you out.
Yes. Like their expectations just got so out of whack. But yes, this is probably one of my bigger long-term worries about what are they going to do eventually when this time comes. Are people going to see their benefits cut as they retire?
How are you playing this? What's the trade?
I don't have any long-term calls on pensions being screwed yet, but I'll think about it.
So Packy McCork wrote a post: "Software is eating the markets. Welcome to the consumerization of investing." And this is one of the best posts I've read in a while, talking about how the markets have changed. And there's a lot in here to unpack, but one of the themes was that retail investors are behaving more like consumers than they are investors. So their motivations are different than institutional investors. It's not just dollars and cents. There's all sorts of things that go into these decision-making process. So here's his quote. He said, "The rise of consumer investors will alter how markets operate." Your take, your thoughts.
Well, first, I liked how he said that in Silicon Valley, it's almost like a bigger show of pride to say that you invested in like Series A of Uber than own a Ferrari. Like that's a bigger badge of honor. But I mean, one of the things we've been talking about for a while is the fact that as bond rates continue to fall and maybe stay low for a long time, people are either going to, by choice or by force, go into more creative investments. And that demand, as Josh always says, is going to the supply is going to catch up with the demand eventually, right?
I love this quote. "Low interest rates favor more fun assets like art, cards, and tech stocks over more boring ones like bonds and value stocks.
I think it's true. And I think there's just going to be a host of stuff coming in the years ahead that will allow people to invest in stuff that they never dreamed of investing before. And actually, I think a lot of this stuff actually favors retail investors over the pros like institutions, because a lot of this stuff isn't big enough quite yet to scale and reach these big professional investors that can invest hundreds of millions or maybe billions of dollars. So this is actually stuff that is something that the retail investor can put their money in, and maybe, I don't know, who knows what the returns for this stuff are going to be, but if it's something you're more interested in.
That's not even the whole point, is his point. That returns are obviously a component of people's motivations, but he said, quote, although they're often derided as irrational or gamblers or YOLO traders, retail traders might be behaving perfectly rational when you price in everything else that they're buying: an experience, a status symbol, a digital good, belonging, entertainment, education, and more, end quote. And I can hear the eyeballs rolling from people who think that they're super smart and this is gambling and this is not what investing is. And okay, yeah, fine. But the world has changed and this is not going away.
And what if this stuff, all those things, the status symbol, entertainment, having more fun, what if that stuff keeps you engaged and invested longer too? Even if the returns are subpar. I know a lot of people have been pushing back against ESG investing in recent years. And I think one of the things they miss on that is, who cares if you get any alpha there or whatever? But if those decisions allow you to stay in your portfolio longer and allow you to behave versus the alternative, then it's a win-win then in that way, if it improves behavior. Maybe some of this stuff will make behavior worse, obviously. It depends on the platform and how much you're able to trade and stuff. But yeah, I think it's going to maybe bring out a whole host of new investors that might not have looked at this stuff before.
So there are companies that allow you to invest in real estate, like institutional, like real estate. Fundrise, for example, we had them on the show a few months back. EquityZen lets you invest in pre-IPO markets. We also did one with them. Masterworks for art. There are so many of these companies, and we've
sneakers, and you can invest in a
cars.
Car.
And by the way, I think
cars.
When I first heard of Valley Road, I'm pretty sure that I laughed and said, "This is ridiculous. Why would anybody?" But that was probably 5 years ago. I mean, I think I saw this at one of the StockTwits events, and I probably laughed. But I think that this thing is here. It's not going away, and I am super bullish on these companies' ability to attract eyeballs and raise assets. Who knows who the winners are going to be? And again, I think that the returns are just one component of these things.
And if the Fed does keep interest rates low till 2023, like they say, who knows if that'll happen?
So for example, I am a perfect example of this. So I, like a lot of other listeners, have kept money in a high yield savings account. I'm saying high yield, that sounds ridiculous. Marcus or whatever, which is giving you 60 basis points. And so I don't want that much cash there. Like so this has made me think my nest egg, not my nest egg, my emergency reserves, right? Like I have definitely less today than I have in the past because rates are effectively forcing me to look elsewhere.
I basically have a ceiling on it, or what I want, or a floor, I guess. And when I go over that floor, I sweep it out and invest it in something else. Because like you said, what's the point if you're earning absolutely nothing on that money? And yeah, I think this stuff is just going to, if they do keep rates low for a while, people are going to want to continue to move out of that stuff and into something more exciting. And so there was a story about Robinhood and Bloomberg. They had it as a cover story, and they said 3 million new signups in the first half of the year this year. Half of their customers were first-time investors, they said.
It's great.
That's a big number, right? They said 80% of AUM for Robinhood is millennial users. And I'm sure it sounds like they're biding their time, and they actually said they've paused their efforts to expand into Europe and Asia after they had that slowdown, remember, in March and April when their service went down for a day. So I think they want to get that stuff right before they really expand. But if they're able to somehow do some more stuff besides just stock trading, if they're able to get into people's somehow help, I know they have like a debit card they've rolled out now, and they have a savings account too. Again, you can't call it a high yield, but they have a savings account there. If they're able to offer other services, checking accounts, whatever, if they want to get into that somehow.
Life insurance.
Yeah, and be that for millennials, I think they have a real shot at getting there.
Do you think that a lot of these newer companies that we're mentioning for alternative asset classes and Robinhood, are these all going to be winner-take-all markets? Like, is there going to be room for competition? So who are we talking about this morning? EquityZen's competition is a company called Forge. Is that right?
Yeah, I can't imagine there won't be competition from these. I'm surprised we haven't seen Robinhood on steroids, right?
What do you
Because
mean?
I don't know. Let's say for the zero commission brokerage firms, Robinhood is the index fund. I'm surprised there isn't a triple levered version of Robinhood yet that is just playing the gamification to the next level and just being blatant about it. I'm surprised that someone hasn't rolled out a competitor yet to them. Maybe it's harder than it sounds, I guess. But I'm surprised we haven't or won't seen something like that where that just takes it to the next level. So okay, let's say what was one of the first, Match.com was one of the first online dating sites. When do we get the Tinder to Robinhood's Match?
Didn't they merge?
Yeah, maybe you're right. But you know how Tinder just broke it down to the most basic. You see a picture and you swipe. The next gamification of that for investing, I don't know.
Well, for Robinhood, in Patty McCormick's piece, he was talking about their competition is a company called Public. And whereas Robinhood is encouraging trading and treating it more like a casino, Public is going the other way. So instead of showing like a ticker symbol for your holdings, they're showing with the logo of the company.
Oh yeah, and they're actually trying to promote more long term. I'm surprised you don't see something the other way, but
what do you mean?
Who knows? Just like I'm saying, that just wants people to just go crazy and trade their faces off.
You don't think that's what Robinhood is?
Well,
you know what's funny? It's not. It's not just Robinhood. Obviously, we use this, the Robinhood effect, and maybe they are certainly the straw that broke the camel's back in terms of nudging Schwab and TD to go to zero on their trades. But this chart from the Post shows retail equity trading volume, and Robinhood leapfrogged E-Trade and Schwab, which is hard to believe, but TD is still way, way, way bigger in terms of the amount of trading on the platform.
Yeah, it's increased everywhere. Interactive Brokers, Charles Schwab, E-Trade, all of them. It's everywhere.
Somebody on YouTube was questioning why I would use a firm to buy a Peloton. So I did this installation payment plan. A firm is like a huge company. They're probably going to IPO sooner than later. And we were reading about this. A third of Affirm users are able to use installment plans with no interest. So Ben, my credit score isn't quite as pristine as yours, but I guess it's good enough that I'm able to buy the Peloton and pay whatever, $60 a month instead of $2,500 or however much it costs. Why would I not take that free money? It's a free loan.
Yeah, I did the same thing. I still don't understand why they offer that. Why do they make that offer? Because for the time value of money thing, why would if someone is going to offer me 0% financing, I will take it any day of the week.
Well, because I think
if there's any inflation, you're paying less over time.
There it is. You used Affirm because you're bullish on inflation. You're an inflation hawk.
If inflation is 0.1% a year, I win on this transaction.
So I don't know how the deal specifically works with Peloton, but I understand that most merchants pay them on the other side as well.
So I bought a Dyson vacuum, and did I need to do it on that? No, but they offered it to me. I'm like, okay, I'll pay $20 a month instead of paying $800 up front or whatever it is.
And listen, I bought a Subway sandwich the other day. It was $6. Can I afford it? Yeah, but
okay. I guess it's one of those things like the people that pay off their credit cards and just earn the rewards, they're being subsidized by the people who don't. I guess, I don't know.
Same as it ever was. All right. My friend Jon Boorman passed away last week from glioblastoma, way too young. I think he was in his young 50s. And a lot of listeners know Jon from Twitter and have met him, and just such a special sweetheart of a person. And I went back and I read truly one of my favorite blog posts of all time that he wrote.
Yeah, I remember when he wrote this and thinking, this is amazing.
Yes. This is not hindsight. Like I definitely tweeted this at the time. Holy cow, this is amazing. And it's funny because I was writing a little tribute to him, and I wrote this and I deleted it only because it just didn't fit. And then so I published it, and then I read this post, and this is the part that I deleted because I couldn't remember. I've been saying this for years. I've been saying this to people for years. Specifically younger people that are asking me about trading and stuff. And I was sort of paraphrasing this, but Jon said, if you want to own the strongest stocks, buy the strongest stocks. Buy something that's already doing what you want it to, going up. End quote. And that sounds so simple. So Jon was a trend follower, meaning he bought stocks that were going up. Period. End of story. Did not care what the S&P 500 was doing. He bought stocks that were going up. So this is such...
And it was also like extremely transparent in the way he did it. Remember, like every week he would share his performance. He would share the stocks he's buying, the stocks he's selling.
Yeah, he was a gem.
And he was basically like, I'm just buying stocks that go up. I don't care about anything else.
Yeah. So anyway, so I just thought that this was such fantastic trading advice to young people that it sounds so simple. If you want to buy a stock because you want it to go up, well, buy a stock that's already going up. Now, of course, the rub is in real life, that's not easy to do.
And I don't know that my personality is suited for that. Right? Like, I think you have to have the right type of personality to take that type of strategy. I don't know that I could do that on a consistent basis.
Well, I try.
I feel like you have to know yourself to know that you're the kind of person who can do that on a rules-based fashion or whatever.
I tried, and it's incredibly difficult. So a lot of people talk about the entry, right? Like, when do I buy a stock? Nobody talks about when do you sell a stock. So John had this amazing blurb in this long post where he said, watch any trading software ad, and you'll likely hear lots about getting entry signals. The perception is it's more important than the others, but it's not. I think exits are more important. A good exit signal doesn't just get you out when needed. A really good exit signal keeps you in, staying just below the action and not triggering until the trend is over. Look back at the entry of a successful position you've held for many months. How important was it to enter at that precise time that day? It's likely what followed was more important. What allowed you to tolerate the volatility and ride it higher to where it is now, making it the big winner it is. That's all exits and position size, not entry. So I think that point is so well taken, right? Like, we just got a listener question this morning asking about, listen, I've got 30% in cash and I understand the math and this time is different and blah, blah, blah. And I basically said to him, if you give it enough time, now this is for an index, this is not stock specific, but if you give the S&P 500 enough time and you really hold on, does the entry really, really matter? I mean,
Right.
Your post about Bob the world's worst market timer, for example.
Right. If you're holding long enough, patience can kind of conquer all. And, one of the unique things about John, I think he was not only a nice guy in real life, but he was super nice on social media. And that's kind of a hard thing because a lot of times you'll find the person that they're in real life is not who they're on social media or vice versa. And I mean, we're guilty of this too, of being snarky and subtweeting people and probably saying some stuff every once in a while we shouldn't. But he would never pick fights.
He never did.
He was like that kind of on and off. And some people, it's hard to separate those two personalities. And he was the same in both. He was never like out to get people. He was always like, this is my thing. If you don't like it, fine. But this is the way I do it. And how you do it is the way you do it. And that's fine.
Yeah. So rest in peace, John. On your episode, Hard Being Rich, a listener had sent in a question about his friend that thinks the financial system is going to collapse and to buy crypto and gold to hedge that risk. You suggested sending the seduction of pessimism to that friend to the listener. I have a similar friend, so I sent that to him as well.
By the way, everyone has that friend.
Of course. And he sent me these two charts. Are these chart crimes? What say you? Reasonable cause for concern? And not to be a jerk, but we laughed when we got these because one of them is a chart. It's an arithmetic chart, which you know what that means. It's just a line that's at zero and then all of a sudden goes straight up. And that chart is the balance sheet of the Federal Reserve. So, okay, there you go. The other chart, Ben, why don't you describe the other chart?
It's the worst chart in all of finance.
Wow.
I say that with no reservation. So it shows currencies over time, and it shows their value in gold. And of course, it's from a gold website.
But gold is just a straight line. So gold,
gold is held constant, and all these other. See, I've seen these before. Like they show the value of a dollar
crashing.
If you showed the value of a dollar from 1913 when the Fed took over to now, it would be worth like 3 cents.
Right.
And that is the dumbest thing I've ever heard because why would a piece of paper be worth more money over time? But so if you invested in 1 month T-bills since 1926, that's effectively a savings account. You would have had 21 times the return on your money versus just burying it in your backyard. So of course, if you just took dollar bills and buried them in your backyard, guess what? They're not worth as much anymore.
So what this chart,
that's what this is saying.
What this chart is showing is every currency crashing relative to gold.
Yes, I love the Reich mark too.
Yeah, it's great. This is an absolute crime against chartmanity.
It is. This is you're going to solitary confinement for this chart crime.